Usually when we talk about personal finance, there's this expectation of control.
Right.
Like driving a car, you hit the gas, you brake, you turn the wheel, you decide to put a little here into a savings account, you put a little there into a bond.
It's all intentional.
Exactly, it's intentional.
Yeah.
But then you look at the macro data for American wealth right now, and suddenly you realize, you are not driving a car anymore.
No, not at all.
You are strapped into a rocket ship that someone else is flying. And the autopilot is locked onto this single, highly experimental destination.
Which is terrifying when you really think about it.
It is. It is the absolute definition of losing control without even realizing it. So for you listening right now, you might not have looked at your 401k in like 5 years. But right now, your financial fate is tied to a handful of tech companies in a way that is just historically unprecedented.
It really is a staggering paradigm shift. We are looking at a massive, largely silent transformation in the very bedrock of American wealth. And it's happening right under our noses.
Okay, let's unpack this. We're going to dive into some recent Federal Reserve records, a really deep analysis from Goldman Sachs, and also some recent congressional testimony.
Yeah, there's a lot of data here.
There is, and our mission today is to look at how American households have literally never been more exposed to the stock market. Right at the exact moment Wall Street is starting to sweat over a potential AI bubble.
The timing is incredible.
It is.
Yeah.
So the sheer scale of this exposure is where we need to start. Because according to this staggering new data from the Federal Reserve, stocks now make up 32% of everything American households own.
Yeah, and we really need to linger on that phrasing for a second, 32% of everything.
Right.
Because when the Federal Reserve calculates household assets, they aren't just looking at your Robinhood account or your E-Trade account.
They're looking at the whole picture.
Exactly. They are looking at the cash in your checking account, the value of your cars, your bonds, your savings, and critically, the equity in your real estate.
Your literal house.
Right, your house.
Yeah.
So when you put all of that into one giant pie chart of American wealth, nearly a third of it is now just equities.
Which is just wild when you look at the historical context. The Fed has quarterly records going back to the early 1950s. And this 32% figure is the highest it has ever been.
Unprecedented.
Literally. Let's compare it to past peaks to really understand the extremity here. Take the dot-com bubble.
Oh, yeah.
The late 90s, early 2000s, when day trading internet stocks felt like, a national sport. Even at the absolute peak of that era, equities only made up 27% of household wealth.
Wow.
We have completely crushed that number. But, the data point that genuinely made my jaw drop is the comparison to the 2005 housing bubble.
The quintessential asset bubble of our lifetimes right there.
Exactly. At the absolute height of that housing bubble in late 2005, owner-occupied real estate topped out at 31% of household assets.
And houses are physical, massive, incredibly expensive, highly leveraged assets.
Right. But in mid-2025, the share of wealth Americans hold in abstract digital stocks surpassed that 31% mark.
Set by physical real estate at the peak of the wildest housing boom in history.
Yeah, and it hasn't dropped back under it since. We have essentially replaced the physical house with the digital stock as the primary store of American value.
That contextualizes the sheer volume of wealth sitting in the market right now perfectly. But, the crucial part to understand is how we got here.
Because it wasn't on purpose.
Right. As the data shows, it wasn't through deliberate, aggressive action by the average retail investor. People didn't just suddenly decide to liquidate their lives and go all in on Wall Street.
No, it was completely passive. I was trying to think of how to visualize this for the deep dive. And it's like, imagine you decide to plant this perfectly balanced, diversified garden in your backyard.
Okay, I like this.
Right, so you've got a row of tomatoes, some carrots, a nice patch of strawberries, and you decide to plant one tiny oak tree sapling right in the corner.
Just for a little variety.
Exactly. You water the whole garden, you step away, and you just let it do its thing for a few years.
Wow.
When you come back, you haven't actively pulled up the tomatoes. You haven't poisoned the carrots. You didn't deliberately try to destroy your diversification, right?
But the tree took over.
The oak tree just grew so fast and so incredibly massive that its roots took over the entire plot and its branches just blocked out the sun. The oak tree completely dominated the ecosystem.
That is a brilliant way to visualize it. I mean, Americans didn't actively move all their cash into stocks.
Right?
And they certainly didn't, sell their houses to buy tech shares. Stock values have simply outrun everything else they own.
By miles.
By miles.
Yeah.
The equities grew so fast, compounded over this historic bull run, that they just naturally overtook housing, cash, and bonds to completely dominate the net worth of the average household.
And this is where it gets really interesting. This isn't a global phenomenon. We have this incredible data from Goldman Sachs that highlights a really stark difference between the U.S. and the rest of the world.
Yeah, the contrast is pretty sharp.
Yeah. It turns out letting the oak tree take over the yard is a uniquely Anglo-American strategy.
What's fascinating here is how geographically isolated this specific financial behavior actually is. Goldman Sachs recently sent a note to their clients pointing out that American, Australian, and Swedish households hold far more of their financial assets in stocks than anywhere else in the world.
Wow, just those three.
Pretty much. Meanwhile, Europeans and the Japanese are still fundamentally sitting on cash. They have a much more conservative approach to wealth storage, prioritizing liquidity and capital preservation over this kind of aggressive growth.
I really wonder how much of that is systemic versus cultural. Because, European pension systems are often state-run and way more robust, right?
Definitely.
So maybe the average citizen there just doesn't feel the immense pressure to personally outpace inflation in the stock market just to be able to, retire one day.
That makes a lot of sense.
Whereas here, if your 401k isn't compounding at 8% a year, you feel like you're drowning.
Oh, completely. That structural pressure is a massive factor. And Goldman points out a really fascinating byproduct of this U.S. equity concentration. They call it the wealth effect.
The wealth effect, okay.
Yeah, it's this economic phenomenon where perceived wealth drives real-world behavior.
Like feeling rich makes you act rich.
Exactly. When people check their retirement accounts and see that the balance has surged by, say, 20%, even if they haven't sold a single share.
Even if it's just paper gains.
Right. Even if they haven't realized a penny of actual liquid profit, they feel materially richer.
And when you feel richer, you spend more. You finally upgrade the kitchen, you take the more expensive vacation. You don't necessarily need the cash in hand.
Yeah.
You just need the psychological safety net of a bloated portfolio.
Exactly that. Goldman stated, quote, "Equity gains have been the dominant driver of household wealth accumulation," unquote. And this wealth effect has actually been the silent engine propping up U.S. consumer spending this entire year.
Which is huge for the economy.
It's a vital pillar of the current economy. But, and this is the crucial takeaway here, it cuts both ways. The exact same concentration in stocks that lifts your net worth and makes you feel confident enough to spend on the way up can absolutely devastate household budgets and freeze consumer spending on the way down.
So if all this money is passively flooding the backyard, the obvious question is, what exactly is it watering? Because it's not watering everything equally. We aren't just broadly exposed to stocks. We are dangerously exposed to a very specific kind of stock.
Right. Technology, and specifically the infrastructure and promise of artificial intelligence.
Yeah, I was reading through the congressional testimony from June, specifically from Sarah Myers West.
From the AI Now Institute.
Yes, exactly. And they study the economic risks of this technology. So she was testifying before the Senate Banking Committee, and she laid out this really sobering statistic that roughly 60% of Americans now own stock.
So the majority of the country is in the market.
Right. But I want to push back on the risk factor for a second here. Because let's say I'm a listener who purposely didn't try to pick winning tech stocks.
You played it safe.
Right. I wanted to be safe.
Yeah.
I put all my money in a broad index fund like the S&P 500. I bought a basket of the 500 largest companies in America specifically to be diversified. Surely the market cares that I made the safe, responsible choice. I shouldn't be that vulnerable, right?
If we connect this to the bigger picture, we actually uncover the fatal flaw in modern index funds.
Oh.
Yeah. The market is entirely indifferent to your intent.
Oh, wow.
A portfolio that just drifted heavily into stocks over time, loses just as much in a sudden sell-off as a portfolio that was built that way on purpose by a reckless day trader.
Wait, so mathematically, if NVIDIA's stock price surges, the index fund is essentially forced to take my new 401k contribution and buy more NVIDIA at its absolute highest price just to keep the proportions right.
Yep.
It forces you to buy high.
That is the core mechanism of a market capitalization-weighted index fund. The bigger a company gets in reality, the larger percentage of the index it takes up. You don't actually own an equal 1/500th slice of every company in the S&P 500.
It's not a flat spread.
No. your money is disproportionately funneled to the winners. And right now, the heaviest weights in the S&P 500 are a group known on Wall Street as the Magnificent Seven.
Oh, right, the big ones. NVIDIA, Alphabet, Apple, Microsoft, Amazon, Meta, and Tesla.
Those 7 companies out of 500. Together, they account for roughly a third of the entire S&P 500 index's value.
That is insane. So 1/3 of this widely heralded, diversified basket is just 7 tech giants betting heavily on AI.
Goldman Sachs warned that this trend has tilted almost all supposedly neutral portfolios violently toward technology stocks.
Violently, that's a strong word.
It is, because it fundamentally magnifies what any stumble in artificial intelligence will cost American households. As Sarah Myers-West pointed out in her testimony, if the Magnificent Seven falter, the systemic effects will be felt much more acutely across middle-class America than in prior financial crises.
Because everyone is holding the bag.
Exactly. An index fund offers absolutely no refuge when a drop in just a handful of stocks is mathematically big enough to pull down the entire index.
Which brings us to the current moment, because the lifeboats we are all sitting in are starting to take on water.
They really are.
We need a reality check on AI, because the market took a massive drubbing recently, and it revealed a lot of underlying anxiety.
The volatility is certainly spiking, and the narrative around AI is, it's shifting from blind optimism to hard scrutiny.
Let's look at the specifics of that. Alphabet, the parent company of Google, fell 7% in a single day.
A massive drop for a company that size.
Huge. And the reason why they fell is just fascinating. It wasn't because their ad revenue collapsed or because they stopped making money. It was because they raised their 2026 capital spending forecast to a whopping $205 billion.
Yeah, let that number sink in.
I mean, when I read that number, I honestly did a double take. That's not just buying a few extra servers. That is accidentally going to the store and buying the GDP of New Zealand.
It is an astronomical sum. Capital spending, or CapEx, is money a company spends to buy, upgrade, and maintain physical assets.
Right.
So in Alphabet's case, they are buying the incredibly expensive NVIDIA chips, the massive data centers, and the colossal energy infrastructure required to just build, train, and run these artificial intelligence models.
And Wall Street looked at that $205 billion price tag and basically choked.
They panicked.
Investors are terrified that the hundreds of billions of dollars being poured into the foundation of AI will never actually be recouped in consumer or enterprise profit.
Right. The return on investment just isn't clear yet.
Exactly. And we saw with Tesla, too, dropping 15% on an earnings miss, which was largely tied to doubts about their AI and robotics timeline. Investors are starting to really doubt the AI gold rush. They are asking, where's the actual revenue to justify this historic spend?
This raises an important question, and honestly, it's the question every financial analyst, portfolio manager, and economist is trying to answer right now.
Which is?
Are we repeating a historical crisis? Because when you mix record-high household exposure with sudden, violent doubts about a new technology, you inevitably draw comparisons to the past. Are we in 2008 or are we in 2000?
Okay, let's take those one by one. Are we looking at a repeat of the 2008 financial crisis? Because we established earlier that stock exposure today at 32% is actually even higher than housing exposure was in 2005, which was 31%.
Right.
That statistic alone feels terrifying.
On the surface, yes, it does, but the comparison has significant structural limits. Here is why it is not 2008.
Great.
The 2008 crisis wasn't just caused by house prices being artificially high. It was caused by the toxic mechanism used to buy them. Leverage.
Borrowed money.
Exactly. Borrowed money. People were buying homes with almost zero money down, backed by these complex derivatives.
Right, the subprime mortgages.
Yes. So when the value of the underlying house dropped even slightly, they were instantly underwater, owing more to the bank than the asset was worth. And that triggered a vicious systemic default cycle.
Sure, I get that everyday retail investors aren't taking out subprime mortgages to buy the S&P 500, but
They are.
But aren't institutional investors highly leveraged? Like, if the big hedge funds get margin called on their massive tech bets, doesn't that forced selling still tank my cash-bought 401k?
That's a fair point. Institutional leverage always presents a risk of severe volatility, and that's the wobble we are seeing right now.
Right.
But a true systemic banking collapse, the kind that freezes credit markets globally like we saw in 2008, requires the foundational collateral of the middle class to be broadly leveraged.
Oh, I see.
Stocks today, particularly the massive retail holdings driving this 32% figure, are mostly bought with cash.
Just normal savings.
Right. People are using their actual savings, their biweekly 401k contributions out of their paychecks. Because the retail leverage isn't there, a catastrophic, cascading, forced selling spiral that takes down the whole banking system is just far less likely.
Okay, so we can breathe a slight sigh of relief that the banking system isn't built on a house of cards this time.
Yes, thankfully.
But what about the year 2000, the dot-com bubble? Because that was a purely equity-driven, tech-focused boom, where companies were valued at astronomical numbers based entirely on the promise of a new paradigm-shifting technology.
Internet.
Right, the internet, rather than actual current profits. I mean, that sounds suspiciously like the AI boom right now.
The parallels in market psychology are definitely there, I won't deny that. But again, the mechanics underneath the hood are completely different.
Really? How so?
Let's look back at the strategy paper Goldman Sachs provided to their clients amidst this recent AI wobble. Goldman is actually advising clients specifically not to sell out of big tech right now.
Wait, really?
Really?
Despite the anxiety over $205 billion CapEx bills? Despite Alphabet and Tesla taking double-digit haircuts?
Yes, for two very distinct reasons. First, historical market behavior. Goldman points out that equities often post their absolutely strongest gains in the final stretch of a bull market.
Like the final blowout phase.
Exactly. The velocity of wealth creation at the top of a cycle is immense, and selling out of a tech-led rally early has historically proven to be a very costly mistake for institutional investors. You risk missing the final explosive leg up.
The classic fear of missing out on the final fireworks. But, I mean, the market can stay irrational longer than you can stay solvent. What's their actual fundamental reason?
The fundamental difference between the tech leaders of the year 2000 and the Magnificent Seven of today. Goldman noted that even though valuations are running very high right now, one thing separates today from the dot-com era.
Which is?
This generation of tech leaders actually generates astonishing amounts of free cash flow.
Oh, right. Because they already have massive businesses.
Exactly. And Goldman is pointing out that these companies are hyper-efficient. Their return on equity, which is basically how much blood they can squeeze from the stone of shareholder capital, is at an absolute record high.
Right. The Pets.com sock puppet wasn't doing that in 2000.
Definitely not.
Webvan wasn't generating billions in ad revenue while building out the internet infrastructure.
Precisely the distinction.
Yeah.
The return on equity across the S&P 500 right now provides a fundamental floor that simply didn't exist in the speculative mania of the early 2000s.
That makes sense.
Apple, Microsoft, Alphabet, I mean, these are entrenched monopolies with incredibly sticky ecosystems. They aren't just selling a promise of AI, they are funding that AI development with the massive ongoing profits from their search engines, cloud services, and hardware sales.
They actually have the cash.
Right. They have the balance sheets to absorb these massive capital expenditures in a way a dot-com startup simply couldn't.
Okay, so what does this all mean? We've covered a massive amount of ground today, from Federal Reserve data to Goldman Sachs strategy to congressional testimony. Let's summarize the current state of play.
Sure.
Yes, we've seen some recent wobbles. The S&P 500 dropped a few percentage points off its record highs in early June when these AI anxieties flared up.
Right.
But looking at the bigger picture, the index is still up significantly for the year.
Right.
The reality is that American wealth is flying incredibly high right now. We are richer on paper than at any point in modern history.
Ah.
But we are heavily, heavily strapped to just one engine. If the AI engine stutters, a whole lot of everyday retirement accounts are going to feel the turbulence.
And that leads to a thought I really want to leave you with, something to mull over long after this deep dive ends.
Okay, let's hear it.
For decades, everyday people have been told a very specific, comforting story about finance. We've been told that passive investing, putting your money into broad index funds, not trying to pick winners and just letting the market do the work, is the safest, most neutral way to build wealth.
It was always a responsible thing to do.
Right.
The ultimate set it and forget it strategy. You buy the haystack so you don't have to look for the needle.
But if the broader market is now entirely dominated by a few massive tech companies, and those specific companies are betting their very existence and hundreds of billions of dollars on one highly experimental technology, artificial intelligence, has the very definition of passive investing changed.
Wow.
By doing nothing, by simply holding a standard target date retirement fund or an S&P 500 index, are everyday people actually making a massive, highly aggressive, active bet on the future of artificial intelligence without even realizing it?
That is a staggering thought to end on. The illusion of neutrality. You think you are buying the whole market to spread your risk, but mathematically, you are really just pushing all your chips to the center of the table and betting the house on AI, completely on autopilot.
Exactly.
It brings us right back to the rocket ship. You might think you have your hands on the steering wheel of your financial future, safely cruising down the highway of diversification. But the data shows you are strapped into a rocket ship, the engines are entirely fueled by the success or failure of artificial intelligence, and honestly, all we could do now is wait and see where it lands.
Strap in.
Right, strap in. Well, thank you so much for joining us on this deep dive into the hidden shifts of American wealth. If you found this information helpful, open the full version of our show and follow us. Consider subscribing for more updates, since one click is all it takes, and please share this with anyone who might not realize exactly what is sitting in their retirement account right now. Thanks for your support, and we'll catch you on the next one.